Good afternoon, everybody, and welcome to Gary's Traders Group. This is your host, Gary Humeski. It is Monday, December the 15th of 2014. Let's get through the disclaimer. As always, these webinars are for educational purposes only. I am not giving any kind of trading advice whatsoever. Okay, I think I last week showed you guys a slide that I thought this guy was coming to town. Well, guess who decided to show up instead? The storm. And this guy came out of hibernation real fast and made a lot of us this last week start running for the hills. However, I don't again think in the macro picture that things are going to be doom and gloom and there's Armageddon coming, because I think the bear will get full of money, get happy, and end up going and hibernating. Okay, my little comical entrance today. I thought I'd start out with that. Okay, let's look at the macro picture first. And folks, it doesn't look pretty. Really doesn't look pretty. As you know, I've started to add support and resistance on a monthly basis for both the Dow, the S&P, as well as the NASDAQ. And so when you're looking at the greater picture here, you'll notice that with Heikin Ashi candles, the Dow has just about tipped and touched the second support level at 1790. And then pulled back up a little bit today, even though we ended up 100 points down. Very wild, volatile day today. We opened up 115 up, went down, came back up, came back down, and then finished the day off down. It means there's a lot of uncertainty in the market. There's things that are affecting this that I'll talk about. The S&P is pretty much no different. You can see where it almost touched the second support level of 1977. If it busts through that, your next level of support is 1953 on the SPX. On the Dow, of course, if it busts through the second support level, the next resistance is going to be, or support level will be 16902. The NASDAQ is no different. It's now bouncing on a Heikin Ashi candle, and it closed at that level off of the 49 EMA. It tried to stretch down. There will be some resistance at about 45.60, but it did bust through the first support level today. So the next true support level will be 45.24. We go through that. It's going all the way down to 44.53. So on all indexes, you can see that we had a overbought MOBO and a decreasing DPO trend line way early. Well, it's continuing its path, but it's now broken the midline on all three indices. So I fully expect this to continue, and I don't think we're going to see the Santa Claus this year. I think the Grinch may steal Christmas, and there's several reasons why I'm saying that. But let's first go look at the VIX versus the SPY so we see what's happening in the fear index. As you see, we have busted through the third resistance level on the VIX. So we've really spiked up hard, and you can see a long tail, which means that they tried to find buyers even further up as the market went down. They couldn't. It settled back down. They tried to find sellers. They couldn't. The buyers were stronger. So it ended up on a bullish day for the VIX, meaning the fear index continued to climb. You can see that same pattern with the detrending price oscillator. The inverse is happening with the S&P. Once again, we're looking at 1977 on the S&P. Now I'm going to throw in Fibonacci's so you can see how closely they correlate. There's the 50% at the third support level of 1946. The 38% is at 1979. That's almost exactly where the second support level is. So you'll find these support levels to be very, very accurate as a means to know when to get out, when to get in, when there's going to be a trend reversal, and so forth and so on. So I wanted to point that out as far as the Fibonacci. I did this on a 6-month basis, simply taking it from the low to the high for a retracement. I did the same thing on the VIX. You'll be able to see the same correlation between the monthly support and resistance and the Fibonacci retracements. The R2, or the first resistance, was at 38. The second was the 50% resistance at 20. Now we've just tried to pierce the 68, the 61.8, which is really the golden number for reversal, at least on this scale of 0 to 100. So I wanted to show you guys that it does really correlate. Okay. Any questions on this? Bottom line is the fear index is still going up. The S&P is going down. I fully expect that trend to continue. Now, there's several reasons, I believe, why this is happening in the economy. Number one, I want to talk about gold and where do I think gold is going. And this is inverse from seasonality. So I want you guys to understand this is based on several events that have taken place, and primarily they're from a fundamental reason, but there are some technical reasons as well. I'll start with the technical. Let's go to a longer term chart of 1 year. It clearly shows that from a technical perspective, GLD, the ETF, is on a longer term downtrend. I mean, it's undeniable. I can take a trend line and take it from the top right down to here, and you can simply see where this pattern is going to continue to go and extend. So from a technical perspective, everything is showing me that gold is going to continue in a downtrend. There are other major reasons, and the 49.89 is a real great indicator for us to use to be able to help verify what a trend is. But I'm suggesting playing the pop as what I'm going to probably be doing on gold. What I mean is gold popped. It's in a distinct downtrend, and I like to play the dips and the pops and let the trend be my friend. So I've got a breakdown on a DPO. I've got a breakdown on both the Person Pivot Study as well as the MOBO. The 49 is distinctly below the 89. The trend is down. It just bounced off the top of the 90% width linear regression. The 89 EMA acts as support. And I think this trend is going to continue from a technical perspective. Now, one of the things that's happening from a fundamental reason why I believe this is that, and why I believe gold will continue to fall further, is the prevailing headwinds of the monetary policy that's out there with all the major banks. And one thing that you should remember as far as commodities like gold versus the market is there's an inverse relationship between the U.S. dollar and commodities. Well, the U.S. dollar is strong, meaning we have stronger purchasing power. Secondly, between the Bank of Japan, the European Central Bank, the People's Bank of China, the whole world is following our lead of what we just finished stopping doing for almost 3.5, 4 years. That's QE. they've all started their own QEs. And as a result of that, it's actually created what I call risk on, meaning it's more favorable to actually go into equities and take on more risk because of the monetary policy that's out there. So, one of the key drivers for gold is economic growth. And folks, it's been anemic. We haven't seen the economic growth that we need to really see. And that, in turn, you have to look at, okay, how does that affect inflation or deflation? Well, there's literally pretty much no inflation. And those are key drivers for the demand of gold. So to really summarize what I see here is I believe that, for the short run, gold is going to go down for two reasons. Number one, and probably foremost, is the inflation fears, which are simply primary tailwinds that create the demand for gold. There isn't any right now. It's pretty much non-existent. That, coupled with the second reason, which is the very accommodative monetary policy with all the different banks that I mentioned, which take the safe haven places like gold and treasuries and take them off the table. So I expect this trend to continue as well as the technical trend. So what I'm looking at doing is basically selling gold, the GLD. Lots of different ways you can do this. You could, for a shorter term run, sell a vertical. You see there's 22,000 open interest contracts right at the 115. Well, that's a little pricey for me at $2.86. Not really. I mean, it's a little bit less than 2% or about 2%. But if I can get it cheaper, why not? So one way to do it is simply buy that 115 January and then sell something further out. You could go out to the 108, or you could just do a $5 spread. Remember, for every dollar increment you have to, on doing a vertical, you have to have at least $100 in your account per contract that you buy. So if there's a $5 spread and we're going to reduce our over costs and we're going to sell the 110s and buy the 115s, we expect the 115s to go up in value. But we've offset the cost by selling the 110. That's called selling a vertical. That's what this is, selling a vertical. So it's going to cost me $1.78 instead of $2.86. Now I'm a lot closer to 1%. So as gold continues to tumble, my profit will continue to go up on this. That's one way I'm looking at taking advantage of the further decline of gold. There's other ways you can do this by simply taking a strike price using from a technical perspective. The pivot point is at 113. You see the first support level, that's the first green line, is at 110. So you could go out of the money and say, I'm going to buy the 113s. Puts, just direct puts. And there's a real good opening. You can even stretch to the 112s and just buy that outright. It's $1.59. Again, about 1.2%. You could also, if you want, sell way out of the money calls. I mean, there's 44,000, and develop a credit. When you sell a call, you develop a credit. I would never suggest going naked unless you've got a very large account. Whatever you sell, you want to cover yourself by buying. But either way, you're going to develop a credit. So it's not a bull call spread, it's a bear call spread. So that's selling a call position. We could go way out of the money here at 120. I mean, Where is 120? Way up here. We could go to 123 if we wanted to stretch a little bit more. 120. I mean, 120 is sitting right about this level. And you see that everything is pointing down. So whatever you sell there to somebody, they think it's going to go up. You think it's going to go down. So you sell it to them for a price, you pocket that money, and then walk away. You could do it on short term. I would suggest if you're going to be selling calls, take advantage of the short-term time decay. So there's plenty that you can sell in here at various levels. Let me go out a little bit further. Strike prices. Yeah, there you go at the 119 level. There's 21,000 open interest. So, you know, you don't want to get greedy, okay, when you're doing credit spreads. That's very, very important. One of the lessons I learned from Scott Macbeth is, you know, how can you make consistent money by doing credit spreads where you create income? Well, one of the ways is you go way so far out of the money, and we're looking about a 3 to 5% return per month. But folks, if you can do that on a consistent level, that's 36 to 60% per year return on your money. Where are you going to find that on your own without going out and doing something illegal? So once again, you could do a credit of, let's say if I did the 119s, oops, excuse me, I did that wrong. Where is that? 21,000. Yeah, there it is. Buy that, sell that. It's not a lot of credit. It's 23 cents. You know, as long as it doesn't get up to selling this call to my first call position. Remember, you know, I sold the 117s. So I don't expect the stock to get back up to 117, which is above here. I could go further out. Won't collect as much money. But that's another method. I don't really recommend that method. I recommend basically selling a vertical on this side and let it appreciate. You could also do it on December. There's 15,000. So I could buy the 115s, which is not even 60 cents out, and then sell the 110s. Cost me $1.38. And I fully expect the stock or the ETF to continue going down. So several ways that you can do that to make money. Just buy puts, sell a vertical. Those are the two ways that I'm looking at doing shorting the gold here. Okay. The other factor that I see in the market right now, and again, folks, this is the time that you should either study and hone your skills and not trade, or take longer term positions to buy time, or if you are going to trade, you need to get your money in and you get your money out. For most of you, I'd suggest probably just studying, shut down for the rest of the year, and not worry about the market and go spend time with your family and your loved ones. This is a crazy time of year, especially when things are working completely inverse of historical perspective. The Santa Claus rally went out the window. And again, I said I think there's reasons why. Number one, I've already mentioned, is all of this global easing that's happening, making it more easy for people to take risk. And there's a lot of fear there. There's a lot of fear that the U.S. government's going to come back into the game because things are just not moving as fast as they should. And that was the whole purpose of QE, is to keep get the economy spurred, and so we could stand on our own feet. Now, the other thing I think that's happening that's really big time in the news, folks, is oil. Oil is at a historical, since 2008, low. It's in the 50s. You can see the GC right here went down 28, I'm sorry, that's gold. it's sitting at $55.31. I mean, why did it get down so low? Well, there are 5 basic reasons why oil is declining so hard. Let's see, /CL. You can see this nasty turn. And boy, you could just follow that trend. Number one, folks, all the big boys have posted their quarterly earnings and forward guidance. We're talking about all the big boys from Marathon to Exxon. And they're going to be very, very reluctant to change that tune midstream because how it could potentially adversely affect the price of their stock and therefore their shareholders. So nobody's going to be first on the block to jump out and redo their forward guidance. So for that reason as well, I think things are going to continue to decline. But there's other reasons. The weak demand that has been out there, it's not your typical demand that is usually there for oil, coupled with the increased technology we've developed in the U.S. for fracking, and Omaha and Montana and all these new shale oil reserves are just pumping out oil unbelievably, which has created a larger supply, as well as OPEC still cranking it out. So you've got shale oil and fracking that's increased oil, OPEC that never turned the spigot down. Couple that with the weak demand. Now throw in the price wars that is happening between the U.S. and OPEC, which continues to go on. And then from a little more global perspective, things have settled down, everybody, globally. Syria, the civil war, has subsided. All the news with my second country, if you will, I'm first generation Ukrainian, I think most of you know that. That whole thing in Crimea and Russia and the whole upheaval that was constantly in the front news of every major country has subsided. So the dissipating geopolitical fears, Russia, Ukraine, Syria, the weak demand, the price wars, shale oil and fracking, coupled with a strong dollar, that along with what I initially said of the forward guidance, and they don't want to be the first on the block to readjust it, everything is pointing to shorting oil. Okay, so that is also, folks, contradictory, though, to seasonality. This is XOP, which is the spider on oil and gas exploration. If you look at historically, this is December, right into May. And again, I'm not saying shorting oil all the way and that it's going to continue into May or June. No, I'm saying in the near future, I feel this is going to continue because of the reasons I said. But historically, there's a strong precedence for oil to go up. There's 75% probability from a historical perspective. So it's contrary a little bit to now the other industry, what it does seasonally. Now the other industry that's also affected, of course, is the energy. Energy as well usually goes up between January and early part of May. So this thing is also going to be, so if you look at all of those things, you say, well, gosh, do I want to go against seasonality? If the overall market trend and common sense and looking around you says yes, don't go against the trend. The trend is going to be your friend, period. Okay? So now, what it does create, folks, is an opportunity that once things do turn around is to buy the dip. There are 4 companies that I'm going to be looking at. Actually 3. I may look at Marathon. I don't know if I'm going to. I forgot the symbol is for Marathon Oil. I forget which one it is. I think it's MPC. That's the relatively new one. See, that's what usually oil is doing between January and March, folks. It's usually a strong pull-up. And what we've had lately, of course, is this here. I fully expect this, though, to continue down. So I'll be looking for MPC, or I forgot what the other marathon was. There's another. I think it's the MRO is the one I usually look at. Yeah. I'll be looking to play the dip on this because here's the run that normally happens. This is a trade, folks, I've been looking at and doing almost consistently. I think I lost on 1 year since 2008. It's a typical run that you want to keep your eyes on. So the three major companies I'll be looking at, though, is Chevron, CVH. No, what the heck is Chevron? I wrote the symbol down. Maybe CVN. CVX is what I meant. I'll be looking to play this run, which is usually pretty strong. I will be looking to play the dip once the oil turns around on ConocoPhillips, that run, and XOM, which is not a big favorite of mine, but it still has the opportunity to run. And when things get this beat down, and it continues to get beat down, the question you ask yourself is it time to run, or is it time to wait and wait for the opportunity? That's one of the things I learned, is not to force trades, but to wait for the opportunity and recognizing those opportunities when they come to fruition. Right now, I'm looking at shorting all of these for the near term because I fully expect, as I said, this trend from a longer term perspective to continue. All the way down even beyond 43 for light sweet crude oil in January. This is January's. I could go out on time, but it would be the same thing. Everything is going to be loading up. Now, this is the futures, folks. So you don't, for those of you who are not familiar how to trade futures, I wouldn't necessarily suggest doing the oil futures, but there's other things out there that reflect the oil industry, XOP being one of them. And you see that there's a lot of short selling in the money for the spot front month. Look at that, folks. That's huge. Huge, huge, huge for January. And a lot of people, I'm sure, are going out and buying time and buying Marches as well. Yeah. I mean, there's 1,595 contracts here. Now, there's also people that are bullish over here. Anything that you go out and buy time, you won't get as much of a bang as quick, obviously, because you've bought time. It will not react as fast to the movement in the short term. But there's more security against volatility. So XOP is one. You could play the energy as well. XLE. You can see a lot of people are shorting. There's a lot of short interest on the energy sector for March, as well as January. There's 121,000 contracts in the money at the 75s. So, those are heads up for people. When you see that kind of thing, there's a lot of other people that are following the same bandwagon. Okay, so shorting oil, shorting gold. I wrote something about GDX. Why did I write GDX? Oh, yeah. Selling a vertical on GDX as well, because this is the other ETF besides GLD. So you can, I'm sure, see there's a a tremendous amount of short interest in January as well as here. There's also long interest, but this could be people selling calls, folks, and just collecting a quick credit and taking advantage of high IV, implied volatility. It's called selling the vol, selling the volatility, and taking a credit and saying thank you very much. So keep that in mind. It's the same thing with January at the 21s, especially when you look at the technical, folks. I mean, that only looks like one thing to me from a technical perspective. It's going down. The leashing effect pulls away from the 89.49, goes way too far, and then it's pulled back in. That's the 49 acted as a resistance level, meandered around it, and now it's tanked again. So that's another one you can short, is those two ETFs on gold. At least those are the ones I'm looking at. Okay, let's look at, there's a few earnings. Be careful with earnings this time of year, but there are a few I want to look at. I haven't done all the technicals on this because I had huge technical problems today. My whole setup for Thinkorswim on my workstation, which is this workstation, which has all of these workspaces and indicators and setups and everything, it all froze. And this is what I use for you guys. And so it turns out it was corrupt. And this is after almost 2 hours of trying to fix this dilemma. And so I finally I had to delete it and start a new workstation. So anyways, that's one of the reasons I haven't done a lot of the analysis on these. But we can go through these real quick. And then I'd like your comments. I think we've got about 15 people on board today, not a full audience because I'm sure some people are taking off. But those of you that are, I would certainly appreciate your comments and thoughts because we can kind of analyze this together. Nike is one of the ones that's coming up, I believe, this week. NKE, yeah, the 18th. So that's coming up this Thursday. It's unconfirmed, but pretty much they probably won't change. And that's aftermarket. So that's what it looks like on a seasonal basis. I don't know. Not crazy about what I see. It's not like a September move, where you see that kind of move, which is a real strong move. 90%. You can see all the blue lines. Historically, they pop up. Here in this area, I see blue lines below the composite and above the composite. Where is it sitting right now? Well, it's on a rip roar, folks. That's a nice looking chart. If I go a little bit further out in time, yeah, it looks like it's continuing its trek. Now on a 1 year it looks overbought, but I see some good consistency in earnings of 93%. And so that tells me they're making money. So what does it do seasonally this time of the year? Always hit your puzzle piece, click, start download. You can always start with the default, the best rating of whole zone, 14 days, and just highlight that area and see if it'll find anything. Well, it found the short, but that's at the end of the month. I'm still trying to find something in this area around the 15th to the 25th. So I can't find it. Again, it's found the long, the run-up. So I'll change it to best profit per trade. And I'll highlight this area. Change to green. 90% long within these dates. Yeah, again, what you folks could do is instead of, trading before earnings to get a pop on a directional, You can always use a strangle. One of the things that, so yeah, Jose, I think that one of the things you could do is wait for the earnings to come out, and if Nike does well and pops up, let's see, on a 3-month basis, it's right at the bottom, at the 3% extreme, at least on best choices. And remember, we talked about the linear regression on best choice is 1 standard deviation, where mine is closer to 2 standard deviations. Okay, so this is 6 months. You could see it didn't quite touch the top, and it's not at the bottom like it would be on best choice for 3 months. Well, yeah, it is. It's right at the bottom. 49 is above the 89. I mean, this is a leashing effect too. See how it's stretched away from that 49? Now it's pulled back towards it. So if in fact it does take a pop on earnings, from a seasonal perspective, there's a much higher probability to short it in this area, 80% probability from a best profit per trade. Best rating of whole zone for that area is also an 80%. It's just giving you a tighter time frame. Well, let's look at if there's any open interest on either side. Looks like there's some interest at the 100. There's 6,178 contracts bought. Delta's over 20. Very cheap at 73 cents. It's less than 1% of the stock price. Let's look to January. Wow, I've got almost double the volume today of open interest for at the money of 95. So if you were to be bullish, now let's see what a strangle, probably out of, yeah, that's expensive. It's 519 for January. What about December? Well, that's still expensive. I think I'd probably go out further because it's either going to go up or down from here. So I'd make money if it goes down on the buying the 97.50s. And if it pops up and goes to over 100, I would make money on the 99s. But folks, that's $4.40. So on a strangle, it's more expensive, but you are covering the risk factor of it, goes one way or the other. So strangle is kind of expensive. Straddle, no different. $5. So based on a little pop, if you were looking at this little area right here again, just a 3.38% move. Uh, 95.43 times 1.0338. Yeah, 98. So you may look at the 97.5. I'd stay away from this earnings and wait for the earnings to come out. Don't take a chance. And then whatever happens after earnings, that's when I would look at, if it really pops up, folks, we know from a charting perspective, it'll pop back up to one of these areas. It'll go above the past high, and then it'll again be overbought, and then there's going to be some short selling because people will be taking their profit. Okay, that's what I would think of that. Let's see, we got some other ones coming out. I don't know if Oracle is any good. Maybe. Hmm. 70% long. Doesn't thrill me. This chart certainly doesn't thrill me. Got a downturn MAC. Again, 90% to 95% of stocks are going to go with the market trend. The market is very bearish right now. So that may not be indicative. But again, I don't want to necessarily go against the trend. So I spoke about earlier. That's Oracle. I don't think there's going to be a lot of people loading up on it, though. Now, there's interest on both sides. Now, see, this is an inexpensive premium on the spot month, which means you could potentially do a strangle on this, and it's not going to cost that much, meaning cash-wise. And even from a premium standpoint, $1.85 is a little over 3%, and then you're playing both sides of the fence. But remember, it's got to move one or the other. If it doesn't move a lot, strangles don't work, folks. So remember that. I mean, it's got to move in one direction or another in order for one to peter out to nothing and the other to really make money. If it stays in the middle, then time decay is going to screw with both of them and you won't make money. So from a charting perspective, nothing really exciting there other than it's done its run up and it's on its way down. Do got an interesting pull-up DPO though, and that's an interesting gap up, and it moved up $1.16, which is actually a positive sign for pre-earnings. A sell-off before earnings is not a good sign. Buying before earnings is. So a strangle could be something you could do at the 41s and then buy the put at 40.5. Okay, what other ones? I want to see if there's anything decent. Oh, we talked about Red Hat, I think, and I had mentioned that before. They're ones that have a pretty strong historical move. Where is it sitting at now? Okay, pulled up, pulled down. Best profit per trade, 70%. It has a nice run up from the beginning of the month upwards, but it did the exact opposite this year. But it is trending upwards. It has a nice roll pattern. It's down on the bottom. And this is another contrarian stock mover. It hit the bottom and it's pulled up a total of $1.08 today. And a DPO that's pulled up. This will be interesting. It's coming out with earnings on the 18th after market. Huge open interest. It's at a 13 delta, which I'm not crazy about. 62.5s. Actually, the 60s look pretty appealing to me. Because the pivot is at 61. The extensions, you can see where they're at. The last high was 63. And January looks like there is a lot of interest here at the 62.5s. They're buying time because you've got a stronger delta, and it's $1.30. So that's a possibility. Darden Industries is also coming out. They own Red Lobster and Olive Garden, DRI. Mm, this kind of looks all over the place. Oh, they sold Red Lobster? I didn't know that. Huh. Wonder why. Thought it'd been a pretty successful chain of restaurants for them. Yeah, I don't see anything seasonally here, so I'd probably stay away. Yeah, you got a lot of short interest on the spot month. Now, you do have some very strong bullish volume today at the 60s. Hmm. Hmm. I actually kind of like this. This is on the 16th. Oh, that's tomorrow. We can't do anything. So forget it. Carnival Cruise Lines. Anybody ever trade Carnival Cruise Lines, CCL? 81% long. 50-50 long. Psh, not good enough odds for me. Out of curiosity, I wonder what kind of open interest and volume there is. Well, you got a lot of bullish interest here in January. You got both sides of the fence here. At 4,669 contracts that are either bought or sold today, more than likely they were bought with an open interest of 6,000. And at the 46 level, you've got probably almost 8 times open interest bought today. But you also see the same thing here on the short side. And there's a lot of short interest in January. There's a lot of short interest or long interest in January. So it's kind of all over the board. And with a 50-50 probability during this time of the year, I'd stay away. Wait for after earnings. And based on earnings, then you can make a trade. That's what I would suggest. No, I don't suggest anything. That's what I may do. Yeah, with a 90% historical probability of short, I think it's going to go down too, Bob. So let's just, at this trend, I would take it down. And if you look at a longer term, it's way screaming overbought. Right? So if I was to do something from a technical perspective, hello, there you go. I don't, unless they've made a, no pun intended, a boatload of money that they're going to bring to the bank, more than likely. And, you know, you got to think of geopolitical situations and people, are they really traveling and spending money on these boats? I would do some fundamental research, but from a technical perspective, they're probably going to go down. Let's see, what else do we got coming out this week? Federal Express. I think Federal Express has already had their run. Their run is usually in this area of October into November. Yeah, they did 14. Look at that. We missed that one. Boy, oh boy. Got to put that one down for next year, guys. Federal Express, and probably UPS is the same thing. Yep. Did 12 points this year. Holy Toledo. Okay, let's write those down. FedEx, UPS, October. That's when we start needing looking at them. Well, let me put down UPS too. See, this way, if you, October longs, you have these, you don't have to go hunting, because these companies aren't going away. Let's see, Verifone. I was never excited about Verifone. Yeah, kind of all over the place. .55% probability long. Well, wait till after earnings. I mean, there is some pretty good consistency there on a short-term basis. Wonder if there's any good open interest or some anomaly popping out. Good point, Jose. One of our members brings up the point of, holy Toledo, look at that, folks. 25,000 contracts bought today at the January 36. I wonder if some people know something, because there's nothing even close to that on the short interest for January. So 75 cents on a $33 stock, yeah, less than 3% premium. So I'd be looking at something of that nature. And Jose, one of our members brings up a good point. Probably both, all carrier services from trucking that are transporting goods and products to all the different places that we patronize to buy services and buy products from are benefiting from lower gas prices, which is very true. And so did retail for the most part. I think the average person put about $300 extra in their pocket from savings on gas that more than likely went towards Christmas and buying presents. So retail probably is going to shine come releasing of fourth quarter earnings on some of the retail stores. So we need to keep that in mind as well. Let's see. I got Oracle, Nike, KMX. I don't like KMX. I've never traded KMX. Yeah, all over the place. Got a lot of short interest, got long interest. I don't even know what CarMax does. I've never traded them. Yeah. Yeah, as my friend in Jersey would say, forget about it. Sitting up high, if anything, it's going to go down. I would short it from a technical perspective if I was short-term swing trading. Joy Global. I don't know what's going on with that company. Can anybody enlighten me about why Joy Global has just done nothing but been beat to a pulp? Somebody asked about Apple. Do you think it will follow the overall market or follow the trend being oversold and then reverse? Yeah, I like Apple, Jerry. I like it a lot. As far as I want to finish up with Joy, and I'll talk about Apple in a second. What's happened with this? From $64 down to $45. They're to do with mining, so usually we had a description. There's no company description available for some reason. But I know from a seasonal perspective, they're supposed to, do well. 10 out of 10, they're supposed to go up. With a 9.52% move, which is pretty hard to deny, folks. Yeah, there it is, 10 out of 10, with some good point and percentage moves. So it's something to consider. When you got that strong of a historical precedent, you really want to take a look, and I would do some investigating of why is this company so beat up. You got 7,700 short interest on the 50 on the spot month, because obviously it's in a declining pattern. You've got all sorts of $5 spreads right here. You see that? They're in $5 increments. Those are people doing spreads. They're buying verticals or selling verticals. There's one person, there's some people, 100 people went out, and maybe that's one person bought a lot of 100 at 40 cents. It means they dropped $4,000. But there seems to be a prevalence of short interest. I really don't see anything on the front month. And from a technical perspective, There's nothing telling me to get in right now. It is bouncing off that low, and it hit a new low last Friday, and it did not break that new low. So that's kind of important to see. If I was to do a Fibonacci retracement from the high to the low, $53.23, 55 is a 50% retracement. And that's probably why you're seeing some people in January at the 55 level. But with a delta of 11, and that's a $10 move, I'd be very reluctant to do that. Let's take a look at Apple. Guys, we know Apple's a strong, strong, strong company. But to trade Apple right now, folks, you know, from a seasonal perspective, there's really nothing telling me about Apple right now. And to hold Apple to January before earnings, there's an 80% probability that Apple goes down in January from a historical perspective. And Apple is sitting right now kind of following this composite. So could there be a long? There could be a long in there. Could pop up. So maybe we could look at a January. I do it from a technical perspective only. It's seasonal. I'm not too excited. The 110s. Let's take a look at the 110s for Apple. Oh, I guess I did my research already on this. Well, it just, can you guys see this, the 50% retracement was the 106. So, you know, this is the run up. It retraced and bounced off the 50, touched it, closed up higher. Nothing from this perspective tells me that it's going to start going up. Now, I use, you know, in a daily chart, I wouldn't necessarily make a decision for a short-term pop, folks. I would use other time frames. I'm just looking at from a longer, you know, everything is trending up. The 49 is above the 89. You can see that. It bounced off of the 89, which also happened to be the 50% retracement. So we were looking at a January 110. And I'll bet you if I opened up that 49, it'd be real close to 110. So I would use something a little bit shorter term to make a confirmation, and I would see what would happen. If I see a day from a daily candle that it's going to pop up, yeah, I like Apple long. I like Apple long. But keep in mind, if we still got a nasty bear market and the bear hasn't filled its stomach yet with money and truly gone to hibernate, well, then I would wait. I would wait. Okay. Any other questions, folks? Give me some trades to look at. One of our members turned me on to a website. As a matter of fact, Bob, I knew about Doe. I just had forgotten about it. It was saved in one of my trading folders, and I'd been consolidating. I saw it. For you people that like a little bit more advanced option trading strategies, Doe is a great place. It's a free site. It's owned by Tom Sosnoff and Tasty Trades. But there's a slew of traders that go in and trade and post their trades. Robin happens to be one that is very active. She's got a very good track record. She does a lot of trades. If people want to be very active, meaning on even a weekly basis, she is. But you got to be a little bit more advanced and follow. So that's a site to check out is dough.com. All right, folks, if there is no trades you guys want me to look at, then I'm going to wrap this up, and I'm going to wish everybody a very, very happy holiday, safe, and a Merry Christmas and a Happy New Year. I won't see you guys until the first of the year. So do enjoy your families, enjoy your holidays, and God bless everybody. We'll talk to you the first of the year.